What's going on, guys? Today I want to talk about how I value stocks. When you first start investing, the first things you learn about are things like price to earnings ratios. You're supposed to buy stocks with low price to earnings ratios, or you're supposed to buy stocks with low price to book ratios. But I'm gonna tell you why those yardsticks, they're pretty much useless. They don't mean much, or they don't mean much as you think. I want to show you one stock that I'm looking at right now. Alright, Charter Communications, right? From a first look, it looks like it's an expensive stock. It's trading at $400. Its PE ratio is through the roof, 128. What else? First year target, 50 cents? Are you kidding me? Let's look at the graph. But yeah, basically all those yardsticks that you learn when you first start investing, like PE ratios, they don't mean much. What has helped me is you really gotta look at a company as if it's a business. That's what stocks are, they're businesses, and you need to know how to value a business. Warren Buffett once said, Warren Buffett, the famous investor, he once said that the ideal business is one that earns very high returns on capital and that keeps using lots of capital at those high returns. That becomes a compounding machine. So what does it mean? Basically, it means a business doesn't need a lot of capital to make money, and that business can reinvest its profits at for a high rate of return. That's what it means. So it's like if a business earns 20% on equity, it takes all those earnings, reinvests, and it earns additional 20%. So it grows its stockholders' equity. The business grows its book value at 20% a year. That's what it means. You want to invest in companies that grow their book value. But what I'm going to talk about is more like book value momentum. Book value momentum is very critical when valuing a stock, I believe. Okay, just let's think about it. If you buy a stock with a price book ratio of 1, and that stock grows its book value at 20% a year for 10 years, and if you sell a stock at a 1 times price to book ratio, you'll get a 20% annual return after 10 years. Sorry if I confused you. Maybe I'll make it more clear, but yeah, book value growth matters, but let's say you buy the same stock at 2 times its book value. That way you only get 10% return on your money. So it's important to compare book value growth to price to book ratio. And I want to show you an equation. Basically, the way you estimate return on your business is you take book value growth momentum and you multiply it by 1 over price to book ratio. And I'll make it more clear in a bit. But let's see. Let's take a look at this. That's Berkshire Hathaway annual report. And as you can see, the book value growth of Berkshire Hathaway is almost in line with its per share market value growth per year. It's about 20% per year, which means that in the long run, price book value growth is going to equal your return on your investment. But it also matters at what multiples you buy and sell a business, at what multiple relative to the book value of the business. So how do you calculate book value growth? Basically, you gotta look at the balance sheet. The balance sheet is the most important document when valuing a stock, I believe. I personally, I don't even look at income statements. I don't care how much company makes right now, what their profits are. In fact, like if a company is losing money temporarily, chances are it's a bargain. So yeah, profit isn't everything. Okay, let's take a look at one stock that I found to be really cheap is Nektar Therapeutics. And as you can see, the book value of Nektar Therapeutics jumped from 3 million to 84 million in just one quarter. It's a pretty big jump, especially in just one quarter. I mean, obviously someone put so much money into the company and that person believes in this company. So that's what I'm looking for. I'm looking for book value growth momentum when valuing stocks. Yeah, let's take a look at Charlie Communications. See, like you can even find Charlie Communications balance sheet on Google Finance. I really feel like it's some kind of like inside job. I feel like those hedge fund managers, they don't want you to make money. Like they want to keep all those secrets to themselves because they're greedy. But anyways, I can look at the balance sheet of Charlie Communications on Yahoo Finance. And okay, so Charlie Communications, it filed bankruptcy a few years ago, and in 2015, the book value of Charlie Communication was negative 46 million, and for the last quarter, the book value is 33 billion. So how do you go from negative 46 million in equity to 33 billion in 1.75 years? It's a huge. I mean, that's why Warren Buffett invested like 3 billion of his in Charlie Communications. That's what makes it undervalued. I mean, yeah. Other thing you gotta look at is price to book ratio. So price to book ratio is 2.9, which is kind of low relative to book value growth. Also, yeah. Yeah, book value growth is very important. It's the most important metric to look at, I believe. Let's see. So obviously, the first thing I look at when trying to find an undervalued stock is I look at book value growth relative to price to book ratio. You want book value growth momentum, either it's for a quarter or over a period of years. You want book value growth to be high, and you want price to book ratio to be low. Sorry if I sound unclear, like, but anyways, here's another important thing to take note of is institutional ownership. Basically, you want to avoid stocks with high institutional ownership, especially when markets are overheated like they are right now. And how do you know if the market is overvalued? Let's see. What I like to look at is Shiller PE ratio. Basically, it's price relative to past 10 years earnings of companies. So as you can see, the long-term average has been like 17, and right now we're at 33.4. So yeah, stocks looks kind of expensive, but then again, the bubble can go even further past like 40 or 45. But anyways, you want to avoid stock with high institutional ownerships. Basically, the more stocks are overvalued, the more the general market is overvalued, the less the threshold should be for institutional ownership. So when markets are very expensive and stocks are very expensive, you want to own stock with very low institutional ownership. But let's say, at which point, like, would you be agnostic about institutional ownership? Obviously, if the market is at the bottom, so stocks have nowhere to go but up, you don't care how many hedge funds own that particular stock. So yeah, institutional ownership matters less and less as stocks as a whole become less and less expensive. But the reason why you want to avoid stocks with high institutional ownership is because the more institutions own the stocks, the more people can sell that stocks for any variety of reasons that may or may not have anything to do with like fundamentals of the company. And if so many hedge funds own the stocks, like there won't be any new hedge funds to buy the stock, so there gotta be some kind of like buying pressure. So like I avoid stocks with high institutional ownership, not because I think like they're going to zero, but because they're not gonna double or triple. Like Amazon, Apple, they're not gonna double or triple. Stocks with high institutional ownership like Google, Alphabet, Amazon, Apple, they only go up if markets keep rising. So you if you're an enterprising investor, you want to buy stocks with low institutional ownership, and more so when markets are overvalued. The more overvalued the stocks are, the more you want to look for stocks with low institutional ownership. Okay, what else? Also, it's important to look at total equity to total liabilities ratio. I like to see a company reduce its reliance on debt. So if a company has less and less liabilities, it means the company is relying less and less on debt to finance its operations. Sorry, like I didn't realize this video is gonna be so long. Oh my god, like I can't believe I have so much to say. Anyways, other thing I look at is the share price of a company. So the average share price of S&P 500 company is like $70. So all else being equal, the lower the price of a company is, the worse it is. Like I say, like I like to view as like low share price to like uncertainty. Like the lower the share price of a company, the more uncertainty it faces. So yeah, like so so if a stock is below like $70, it's already below average. So and the more and more it goes below average, the less relevant, like the more uncertain it becomes. So like that's why penny stocks are so risky. Okay, what else? Also, uh, I signed 3.1 premium. I pay 3 times more for companies run by founders or co-founders, or if the co-founders or founders play a major management role. Also, if a woman runs a company, I signed 1.36 premium, which means basically women don't start a lot of companies, but like those women that do start companies, and uh, I mean, if a woman uh, is in charge of a company, chances are that company is going to perform better than those run by males. I guess like woman has something to prove. Also, market capitalization. Market capitalization is important. Size matters. Like basically, I view as the bigger company is, the more relevant it is, because big companies can big companies like Google, Alphabet, Amazon, Facebook, they produce very high returns on equity on large sums of money. It's much harder to make money from large sums of money. So just because of the fact that like they can manage that much money, they deserve a premium. So like a $10 billion company is more relevant than like $1 billion company, all else being equal. So yeah, those are the things I look at when trying to value stocks. I actually built an Excel model where like uh, basically I look at various factors and I try to assign weights to different factors, and I try to value stocks, and the higher it is, the higher it's ranked, the more undervalued the stock is. So as you can see, Charlie Communications and Nectar, Amazon, those are my most undervalued stocks. But yeah, that's all I have for today. Wow, I'm exhausted. But like, this is the methodologies that I use to value stocks. I'm not saying I'm an expert, but I would say I definitely know more than an average investor. So that qualifies me to make a YouTube video, I guess. But yeah, that's all I have for today. I hope you enjoyed this video, and I'll see you soon.